Hello, and welcome back to our weekly market recap. I'm with Rich.
Hello, everyone.
And I'm Knight. Let's get to it. This past week, the market fell 1.91%, one of the biggest moves we've seen in the past few months. We're still up 10.92% across the S&P 500 year to date. Really, the big market movers this week was the Fed meeting. Now, we knew it was coming in June for a while, but some of the remarks that they had were a bit surprising. Tiny bit of a reversal, not a complete reversal, but a reversal from what they had been saying. We have the meeting on Thursday. Then on Friday, before the market opened, we had some more commentary from the St. Louis Federal Reserve member, Bullard, and it also had some effects on the market. So as we see, we start off the week and really it's low volatility, not even much going on until really Thursday. We see a little bit of volatility leading up into the Fed discussion on Wednesday, but really the volatility starts on Thursday. This is the exact moment that they were having Jerome Powell speaking about the FOMC meeting. And a couple of the things that he said were pretty surprising. One, he admitted inflation currently is higher than they expect. And because of that, they released numbers saying that they were actually going from potentially raising no rates until 2023 to now raising rates twice in 2023. Now, that's a pretty big change. I think the market in some degree was pricing in one rate change for 2023 and somewhere between the second and third quarter of 2023. Now, with the new dot plot that came out, which I'll show, what we see, the norm is to raise rates twice. So we saw that happen and the market started to sell off. Then it ended up recovering by the end of the day, really based on some of the other things that Jerome Powell said. He said, in general, we still think that inflation in the long run is around 2 to 2.2%. So nothing really scary. This year, they can see it up around 3.5%. But in the long run, he reiterated they're more worried about disinflation than they are inflation. So the next logical question is, what is this big drop then that happened on Friday? As we can see right at the end of Thursday to market open Friday, we just had the majority of the losses that we experienced this week all happened on Friday. And really, that all comes down to what the St. Louis Fed governor said. And his expectation, he came out against what the Fed claimed and said, look, I think by the end of 2022, we need to be raising rates. And that spooked the market again. And really, we just never recovered from that and continue to see some sell-off and even an extra sell-off into the close.
Bullard making that comment had double effect as I can see it. One is the market and most investors don't like surprises, don't like lack of clarity. To have Powell say he's worried about disinflation long term and talk about possibly doing 2 rate increases in 2023, but not in 2022 is one thing. And then having the very next day, a governor of the St. Louis Federal Reserve Bank basically disagreeing publicly with him and saying, well, I really think we should be raising interest rates in 2022 and stepping things up. Well, that creates a lot of confusion. And whenever we have a lot of confusion, we usually have a down market.
Yeah, now just to share the actual dot plot. So the dot plot is what we get from the meeting, and it shows where people stand. And so as we look for 2021, we don't expect, everyone's still at zero, don't expect any changes, 0 to 0.25%. But this is where we start to look in 2022, 7 people out of the 18 are saying that they actually could see a rate increase. This is where we're a lot closer to 50-50, it's 7 and 11. If we had a few people end up switching over, we could see a rate increase. Clearly, Bullard is one of the ones who is likely up here. He's one of the more hawkish people. And so he came out afterwards, but he's not the only person. So I think that's important to discuss, that it's not like it's, 17 against 1. It's really 7 against 11 right now. And then if we look in 2023, 13 out of the 18 are saying we want at least one rate increase. And if we look, 11 are, looking for two, and then, two people are looking for 3 rate increases. So this is what the market was really reacting to. Something to note, though, in the long run, we see everyone basically consolidate right around that 2 to 3%. Now, Rich, one of the interesting things that is no surprise in the long-term run of the Fed, we've had individual governors disagree with the overall claims before, but what effect does that have on the market?
Well, there's a lot of confusion because you don't know which of these groups is going to win. Will it be the doves who want to keep the interest rates lower, or will it be the hawks who want to raise interest rates sooner? And depending upon which of those win, you may want to invest differently. And that lack of clarity creates confusion. And usually when we have confusion, the market drops.
Yeah, well, when's the last time that we saw something like this in the market?
We saw a great deal of this under Bernanke right after 2008, and we had a great deal of market volatility at that time in relation to the various governors speaking out and giving different opinions than he did. Now, that came off of Alan Greenspan's Federal Reserve, and when he was president, no one else really talked at all. And he was able to keep all of the other governors in lockstep. It was actually pretty amazing. And then Bernanke had a very different style, as did Yellen.
Yeah, so what we're seeing is, again, we love a consolidated group that all is agreeing with one another. And so having, something come out on Thursday and then someone come out, on Friday disagreeing or at least putting his own opinion or spin on it does lead to some frustration within the market. And really the place that we've seen it the most is in the bond market. So as we look at the daily treasury yield curve, and as Rich wanted to highlight, we start the beginning of the month and then each day as it continues, the daily rates are posted. Now, what I want everyone to look at is the 5-year and the 30-year. If we look at the 5-year, we see this spike from 0.79 up to 0.89 right around when the Fed was speaking. And the 30-year, we see it remain stable and then start to drop. Now, that very much follows what the Fed was saying, how they are expecting increase in inflation in the shorter term, but in the longer term, potentially lower inflation or even disinflation. Now, what does that mean? It means that on the 5-year, people started selling these bonds. And when you sell the bonds, rapidly flood the market, the yield ends up going up. And that usually happens when people are afraid, oh, inflation is going to spike up. But on the other end, on the 30, oh, now we're afraid that growth is actually going to slow down in the long run. I want to buy these yields at this price. If we even look from the beginning of the month, we have 0.81 and 2.3. So we drop 19 basis points on the 30 and gain 9 basis points on the 5, so far this month. Why is that important? We talk a lot about the yield curve, and as the yield curve starts to get flatter, that's usually a worrisome sign for the economy. In the long run, the economy might not be growing as well or might struggle for long-term growth. And if that's the case, all the reopening trade, all these pieces that have done really, really well over the past 6 months, 8 months, if we do see a slowdown in the economy, that's not a great sign for that trade long term. However, if the economy's struggling to grow, they go into growth names. So from the Fed's perspective and what currently the yield curve is showing us is that in the long run, a potential bias to growth might be a better move. In the short run, it might be a little painful. Overall, kind of a wild week in the market, a lot of movement, and a lot more to what the Fed said. Well, as always, we appreciate you guys listening. If you could do us a favor, hit a like on this video, subscribe to our YouTube channel, share this video with lots of other people. And as always, we're here to support you. Your money's here to support you. We'll see you again next week.